Hello, everyone, and welcome to Taking Stock After the Bell, episode 66. Joined as always by James Hughes. James.
Hello.
And delighted to be joined today by Ben Rogoff. Ben is the lead fund manager on the Polar Capital Technology Trust, having joined Polar Capital in May 2003. Also the fund manager of the Polar Capital Global Technology Fund and the Polar Capital Artificial Intelligence Fund. Prior to joining Polar, Ben began his career in fund management at CMI as a global tech analyst, moving to Aberdeen in 1998, where he spent 4 years as a senior technology manager. He has a BA in modern history from the University of Oxford. Just by way of a little bit of background, the Polar Capital Trust is today valued market cap of 7.3 billion. I assume the fund's got a whole load more assets in it. It resides in the index that some people call the FTSE 100, and it was established in 1996 at £1 a share.
Sounds about right.
Yeah,
predates me.
I think so. And we've got the chart here, Lena, chart 2, and the effective split adjusted share price today is about £65. So it's a 65 bagger over the course of 30 years. 30 years this year.
Yeah.
So congratulations on all that. It did, I mean, as the chart shows, a pretty steep drawdown in 98, 2001, wasn't it?
But formative years.
A long time ago. Let's, we'll come back to the trust and the mechanics and things like that later.
Sure.
I was quite like asking this because Husey and I started our careers in the early noughties in the aftermath of the dot-com boom. And we, as a result, have got a soft spot for resources and outer Mongolian mining companies and Falkland oil and gas companies. You started your career roughly in the mid-90s when the tech boom was really getting going, the dot-com bubble as it turned out to be. And then presumably you were there when it all blew up and the NASDAQ fell 90%. How do you think that impacted your view on the world and your view in investing and shaped you as a fund manager?
Well, I think we're all a sort of sum total of our experiences, aren't we? And we all carry, certainly investors, carry tons of scar tissue. And I think, it was an amazing time to start out in the industry. My colleague at Polar, Nick Evans, started out at a similar time and could be a little bit later. And I think, I guess I've been very lucky in that the AI cycle we'll come back to, obviously, is probably the second, kind of critical moment or key moment in technology and maybe human history. The first one in at least my life being the internet. So I mean, there's some very, very strong parallels between what we're seeing today and what we were excited about in the mid-90s and the building of the commercial internet before the years of the dot-com melt-up. What have I learned? I mean, I guess, you tend to do most of your learning, certainly as a younger person in this industry during difficult periods.
Yeah.
And I think that probably has left quite a lot of scar tissue, actually. That period of sort of over-exuberance and then how it ultimately played out, how much lower, where a value investor thinks there's value being quite different to where a growth investor thinks there's value. Watching actual companies come public and disappearing within 18 months is quite an experience. And so, again, I wouldn't really wish it on anybody, but having it bookended a very exciting period prior to that. And that doesn't kill you, makes you stronger. And I hope that period has made me a better manager. It certainly has helped us understand some of the parallels this time round. I would say on balance, actually, the other thing it has done is I've ended up probably carrying more liquidity in the portfolio over the 20 years that I've managed it than I probably should have. And maybe there's, maybe that's the actual, what scar tissue actually has looked like. So, we obviously have the ability to gear. We've used gearing on occasions. But I think that perhaps that 00 to 03, 06 period was, maybe left a little bit more scarring than I would have liked.
And then we went through it again, didn't we? I mean, obviously, as I said, I started 05, 06, and then it wasn't long before we were into financial crisis, getting hit over the head, Europe. We didn't really come out of that until 2012, 2013. And even then, I do remember being saw fake, we're all going to collapse again. This is awful, But I think you're right. You never regret having dry powder and liquidity available when the proverbial is hitting the fan, because that gives you optionality.
100%. And also, I think you just, there's so many great things to say about the tech sector, but, on the way up, one of those great things is just operating leverage. I mean, these are wonderful businesses with incredible, incremental margins. And unfortunately, that works both ways. And so, again, I was never really an investor in companies that required capital. think listed markets do a very
Mm.
poor job of pricing assets like that. We just don't do binary. Haven't done for my entire career, but in that period, had you been invested in companies that required capital, that they went to zero. Companies that were didn't have balance sheets and so on. So I think that has definitely left its mark. And again, today, for example, we don't invest in companies that we believe are going to require more than 2 years to get to cash flow break even.
Yeah.
So there's an actual example
Yeah.
of what an earlier period can do to help you refine the way that you invest. And of course, that means that you miss stocks.
Yeah.
I think it's again important lessons from prior cycles.
Yeah, we'll come back to that because I think I want to ask you about private markets, and we've got obviously SpaceX coming tomorrow. By the time this comes out, it'll be out. We've got Anthropic filed, we've got OpenAI filed, we've got some big IPOs. So, but those companies are very different to the Pets.com and even the Amazon.com that came public in the late 90s in terms of the capital requirement. They're much more established businesses.
Yeah, I mean, I would liken them to Yahoo coming public in 96 or eBay coming public in 98. And I think that it's very easy. There's so much bearish narrative around this AI cycle because it's happened so fast, so furiously, and has left a lot of people sort of wrong-footed.
Yeah.
So I think that, again, large IPOs obviously going to sort of suck liquidity out of markets perhaps over a short period of time or compete for assets in a way that they wouldn't be if they weren't there. But that doesn't mean that it's the end of a cycle. These are companies that have been private, not the large language models, obviously, or the frontier labs, but certainly SpaceX has been a meaningful business for a very long time in the private domain. And there are lots of others out there that about that have stayed private for longer. Yeah. The companies that came late in the late 90s were companies that had literally been incorporated 5.5 years before IPO. There's a very different cohort of companies than the ones we've seen so far.
Can I just run through a few charts, Yuzi, and then we'll get into to sort of set the scene. So chart 3 here, I've got a chart. The top pane is the tech sector or the global tech sector in blue over the last 10 years. It's gone from 100, this would be index points of dollars, to $900, whereas the global broad equity markets only up at 337. So we can see the ratio chart there at the bottom. So the tech sector is essentially 2.7x the global equity market for the last 10 years. Pretty decent. More recently, a couple of kind of things to note. Semiconductors versus software really has been the main story in the tech sector in general. The semiconductor sector has been very strong up until 3 days ago, whereas software has been very weak on disruption risk around AI intelligence and applications. And again, I'm sure we'll touch on that. And then I guess in terms of, the most popular client question we have at the moment is, why has my portfolio gone up so much when the world, have you seen the news? And we point to this chart, which is MSCI World, chart 5 on the right-hand side. Estimated profits growth this year for 26 is 26%, but the contribution of the IT technology sector in general, where the sector profits are set to rise by 70%, which is predominantly a function of that AI build-out semiconductor story. So, and then the final chart I think I show is chart 6, which is just the valuation. Is it 99, 2000? The blue line here is the global technology sector 12-month forward P, which sits on 25.9 times today, which is bang in line, if not slightly cheaper than the last 5 years.
Right.
And compares very favorably to 55 times at the peak in 98, 99. So in terms of scene setting for the tech sector in general, it's been a really strong 10 years. Profits are growing very strongly. There's lots of dichotomy in the sector, but you wouldn't look at the valuations and say that they're in bubble territory. Is that a sort of fair analysis?
Yeah, I think it's a very good synopsis of why we are where we are. And I think you made the point about how well tech has done over time. And I think that ultimately, you only have to make a good few decisions in your life. And one of mine was obviously becoming a tech specialist more than 25 years ago. But why has tech performed so well? Because it's grown its share of GDP, because it's delivered earnings well in excess of the market. And the things that we used to spend time doing, and profit pools that have been basically redistributed, as a kind word, away from newspapers and high street shops and into the profit pools of tech companies. And if you look at the returns in that recent period that you showed earlier, I mean, most of the earnings growth in global equity post the financial crisis has been driven by tech.
Yeah.
I think that's the elephant in the room, and that doesn't have to continue indefinitely. Of course, there can be things. In fact, one of the themes that we're excited about, and maybe you referenced resources earlier, but it seems to us that one of the kind of key takeaways from what AI promises, and we're already seeing beginnings of, I think, is this idea of digital abundance, and that juxtaposes very interestingly against physical shortage. Lots of people are making that call, but I think it's most people haven't lived in a world where there's been physical shortages of anything. I mean, we have during the pandemic, of course, but I mean, in an investment sense, we've lived against a disinflationary backdrop. Services have been service side inflation has always been outstripping goods inflation for a very long time. And again, we wonder if that might be coming to a sort of a bit of a crossroads with obviously this idea of abundant cognition and AI could have a similar impact to what happened when the Chinese entered sort of global manufacturing and what you saw with goods deflation, disinflation, deflation. So, at the same time, we have to physically build assets against AI demand.
Because in your strategy paper, you've sort of highlighted return of physical assets, haven't you? How are you getting exposure to that in the trust, or is it too early yet, or have you started?
Well, first and foremost, I mean, this is a technology company, a technology trust, so there's only so far that we can stray from our mandate, or at least try to move the borders of where it is and isn't acceptable to invest. And a few years ago, in fact, more than a few years ago now, our AI team. So we have an AI fund within our team, which is run by someone else. I'm a name manager on it, but it's a global equity portfolio, and so its remit is obviously to search through anywhere of interest where AI is having an impact, and it identified the managers. We identified the power sort of complex as being a potential bottleneck, given how power intensive AI is relative to old-fashioned serial compute, and that led us to companies like Jivanova or Siemens Energy or whatever it might be. We've got lots and lots of exposure in power, so that's an example of something that's physical. It can't be created with code, but it's it's not a metals business, and we're not in the mining world either. But I think that if you looked at the gross margin profile of the portfolio as a proxy for this idea of rotating away from software, or the sort of this idea that from all of my career really, apart from in that early .com period, hardware has been commoditized. It's the workhorse. It's the bit that everybody else sits on top of and builds wonderful business and uses this commodity hardware. And that's maybe not been true for Apple's iPhone business, but it has been true for most parts of the world that we touch. Hardware has been commoditized. All the value's been in software, and that seems to be just flipping on its head here. And again, we can come back to it, but I think in the end, software is built on code. Code is being challenged by AI. Again, we can come back to it. So to the question, areas like power, transmission, cabling, those are companies that will have meaningfully lower gross margins. So we used to be a 70s type gross margin profile portfolio, and now we're probably at the very low end of the 50s. So we brought our gross margin profile down a lot to sort of make sure that we're not on the wrong side of that idea of abundance and scarcity.
And in terms of AI in general, it sort of seems to me, we've been through the charts, and hyperscaler capex is going up and up and up. The Googles and the Metas are spending more and more and building out the physical infrastructure. You make a point about physical. I mean, this is stuff. So these companies are changing, but perhaps we'll come back to that. And it seems to me that they are doing it because they see a demand for the end product of these services, whether it's Anthropic, Claude, ChatGPT, Copilot, whatever it might be. So they're continuing to spend more and more and more because they see the demand. Is there a sort of element of hype in that demand is slightly over? Or is there a risk that demand is over-egged, or actually we underplaying the demand? And perhaps just touch a bit on Jevons paradox, et cetera,
sure.
in all that.
Well, okay. So, I mean, 25 years into the industry and thousands of company meetings later, I think it's fair to say that no company will ever explain what it is they're doing, or at least why they're doing what they're doing. And I think at face value, the build outs of the hyperscaler capex is really designed for two things. It's designed to, in most cases or many cases, build frontier models, i.e., the next model that's going to move the whole AI story forward. Again, we can come back to the sort of model progress and scaling laws and what have you if you're interested. The other reason, obviously, is to do the inference, the kind of actual the work, carry the AI workloads. And I think in prior years, in fact, we describe this in lots of our documentation, read online. But we describe it as sort of, we feel like we're in a sort of phase 2 of the AI story. Phase 1 was very much the build it and they will come period, where there really was an absence of revenues, and all of the build was associated with building models.
And that was the sort of idea that the tech bros had read all the books about disruption, and they were like, we have to build it or someone else will build it and we're dead. Is that?
Yeah,
is
there's
that
some
fair?
of that. I think again, there are some truly brilliant individuals that were there at the time of the transformer at Google and elsewhere, and that they've they've understood what the transformer has meant for the trajectory of AI model progress. AI had been making progress for 60, 70 years, but the transformer has allowed sort of a completely different approach. And this is something that Google, a white paper from Google basically highlighted. And it's just changed the whole trajectory of AI model progress. So yes, tech bros, but also just brilliant people at the coalface. And I think that what was very interesting in that early phase one, and why we were sort of maximum bullish, we describe ourselves as AI maximalists, is that we lent into what those people were telling us, and we were listening to not just the Sam Altmans and Dario Amadeus, but also great people at Microsoft and Google, and they were telling us that in podcasts or papers that scaling laws were alive. And what I mean by that is that the idea of more larger data sets, more parameters, and most importantly, more capital, more money, were having demonstrable, in fact, observable and predictable outcomes on model performance. And so that early period, you had to believe that, and you had to believe that GPT-4 was going to be meaningfully better than GPT-3. And I think as a rule of thumb, it's people expect that models will continue to evolve at the pace that they have been. But I mean, for 100% model improvement, it's sort of widely considered that you need to spend an order of magnitude more. So again, that's been, you've had to make a leap of faith in order to be in that as an investor.
When you listened to those podcasts and read those white papers, presumably this was a while ago now, 2, 3, 4 years ago,
Sure.
did that shape the portfolio? Did you particularly the trust? Did you move right? Well, this is what we're going to do.
Most important. Well, I mean, look, we launched an AI fund. It was called an automation and AI fund when we first launched it 8 years ago, with a view that at some point AI was going to be the next, the most important thing that had happened since the internet, and then of course the transformer lands, ChatGPT. We didn't know about the transformer in 2017, but we obviously knew about ChatGPT when it landed in November 22. May 23, NVIDIA has that phenomenal quarter.
Blowout quarter.
Yeah, and a sort of a guidance that no one has ever seen before in the history. And I think that, in fact, it's quite funny actually, as a quick segue. I think one of my first days at Polar, I think May 2003, Genentech, I think, biotech company, landed Avastin, and the stock was up, I think, 60% on the open, and it was in my index. And I was helping Tim Woolley at the time run the US book, and we covered we had a zero. We covered the position on the open, and the stock never went back to that level ever again. And just moments like that. So that was not dissimilar to how we approached that quarter from NVIDIA, which was that we had been super excited about ChatGPT ever since we'd seen it. We had read about it, we put it in our strategy paper in January of that year, and we had started to sort of do more work. And then this quarter around, and that's when we went essentially all in on the AI trade, because it was at that moment that you realized that, and of course, the people that were spending the money with NVIDIA were the companies that we're most excited about.
Yeah. And then how do you think AI is beginning to embed itself, particularly in enterprise? And then we talk a little bit about revenues from the ultimate products and services that the AI, Claude or whatever it might be, Copilot, and how is that ROI, return on investment, positive for the hyperscalers?
I guess on top of that as well is token spend, and budgets are being blown in terms of what they're having to spend on compute, as in normal businesses. What that does worry me, as I think for me that's a roadblock. How do you think about that?
Well, one thing I should have said, if I may, I talk a lot and then end up forgetting what I was supposed to answer the question.
We could probably do 4 hours of this.
Yeah,
this is a problem.
Let's, for your sake, let's try not to. But no, one thing I should have said previously was they're the reason you asked about capex, and the capex was about building models and then ultimately carrying the traffic or the workloads, the inference. But of course, there's a third reason, which is the one that no one will share, which is, of course, that there must be defensive reasons too why companies embark on capex. And I think that, again, we were kind of alive to that a long time ago. We meaningfully reduced our Mag 7 exposure, not to all hyperscalers equally, but we have, the Mag 7. Let's just use that group of companies as a proxy for what I'm about to say. They are the dominant. They dominate the profit pools of the smartphone / cloud era.
Social media.
Right, social media, and smartphones themselves, obviously, streaming content, the Spotify's or Netflix's and so on, the software companies, the Microsofts and others. So these companies are dominant of pre-AI profit pools. And many of them are obviously building, or certainly the Microsofts and Metas and what have you, are spending hundreds of billions of dollars for good reasons. But there is obviously, for almost everyone spending money today, a defensive reflex too, which is, of course, that in a world where AI, displaces or redistributes profit pools, then Microsoft has 450 million people using productivity software that may become moot in an AI world. Google is 90% of its business comes from advertising. And exactly. So again, I just wanted to make sure that I made that point, which is that companies, of course, don't share their fears. They'll certainly share their excitement, but they don't share their fears. As to the question on spending and revenues, because phase 2 is all about revenues. And the reason that you asked a long time ago now, like, why is it that my tech has done well against the backdrop of Iran, Trump, I don't know, just $97-$100 oil? And I think the answer is really that CapEx budgets have carried on moving higher. And I think anybody expected there to be upward revisions to 26 numbers in Q1. You've just seen Google come to market with, a very surprisingly large and just surprising secondary offering. This is a company, I think, with 200 billion or thereabouts of gross cash on its balance sheet.
And Supermicro today as well.
Sorry, second.
Supermicro computers done 8 billion today.
I'm not going to pass comment on Supermicro. I'm not a holder and have never been a holder. But that one, that's sort of interesting. But Google more so, because obviously it's a company that has very deep pockets and incredible business. So why is it coming to market? And again, let's not go there yet. But just CapEx budgets have moved higher. But the real story of 2026 is Anthropic's revenues, where the company was on a $9 billion ARR in January, and I think is on 47 billion or something at the end of in May. Or is it April? But we've never seen a company do this before. In fact, when it reached 30 billion of annualized revenue, we had charts that showed that no company on earth has ever done this before. So that gets to the question of what is it that companies are doing, because the Anthropic takeoff of revenue takeoff is a function of enterprise adoption of AI. So why now? Why has it taken 3.5 years for enterprises to adopt something that lots of people, 1 billion people or what have you, or 950 million people are using OpenAI, for example? Why has it taken 3.5 years? And I think the answer there is models have got good enough. You look at all the early pushbacks on models were around hallucinations and just not good enough. And in the end, good enough for a consumer is not good enough for an enterprise. Enterprises need repeatable workflows. That is the sort of the backbone of a business. So now we have models that are on many different benchmarks at human plus levels, and obviously improving all the time. So they don't make mistakes. If they do, they make no more mistakes than humans. And I think critically, in this sort of, we had reasoning models about 18 months ago. So the ability for models to not just try and answer a question based on what it's been trained on, but being able to break down a question and then go out and find the answers and then recobble it. But then most recently, probably the most important thing that's happened in the last 12 months is this sort of new class of models that are not only reasoning, but are able to call tools. And this is something that's probably too technical, and I probably won't do it justice, but this is the idea that the large language model is beginning to act much more like an orchestra, like a conductor or an orchestrator than the orchestra itself. The models are now able to understand that you don't have to do the maths inside of what we would describe as token space. You can call a Python tool that could do the maths for you while you synthesize, let's say, the information on your tax return. The maths of the tax return can be done in a sort of side pocket in a Python tool. And then once you've done the maths there, you bring it back into token space, and all of a sudden, what was essentially a probabilistic thing, because in the end, large language models predict the next token. But if you can call tools that are deterministic, a large language model can tend to a deterministic. And of course, what that means is that you can ask the same question twice and essentially get the same answer. That's important. And then finally,
make them more efficient as well and optimized in terms of.
Perhaps. I mean, the next thing I was going to say was that as the models have also got bigger and stronger, and again, it's no easy parallels to sort of illuminate this, but they are there's been a breakthrough in coding, which of course has been the lead application for Anthropic in terms of revenue generation. But the breakthrough on coding is really a breakthrough of AI work that hasn't required humans in the loop. And if you went back to ChatGPT, so 2023, software work without a human in the loop, the models could have done something like 35 seconds of human equivalent work. The models today are said to be able to do 14 hours of equivalent human work without humans in the loop. So what that ultimately means is agentic AI.
Yeah.
And I think that's really the story of 2020, 2026, and that's why Anthropic revenues have gone vertical, and that's why the tech sector or certain parts of the tech sector have been sort of very strong against a much more difficult backdrop.
Can you describe to our listeners and hosts what exactly agentic AI is and how that matters and how that's important for the investment case for these companies?
Yeah, it's critical because essentially it's the non-human scaling part of the AI story. And I was actually at the weekend watching a Western. My late father was a big fan of Westerns, and I was watching The Big Country. And as they like to tell you in the movie, it's a big country. And when you live in a big country at that time, it's a horse and carriage, and essentially information can't flow any faster than an animal. And then of course railways change that, and telegraphs change it, and so on later as well. So the idea of information traveling faster than a human, or cargo traveling faster than a horse, is the idea of non-human scaling. And in the world of cognition, because of course in things like agriculture we know what that means. We used to have people with scythes and hoes or what have you, and then we had combines and all of that stuff in the 19th century, and we had the same with the Industrial Revolution and factories rather. We believe that agentic is sort of the sort of beginnings of non-human scaling. So by which I mean, before agentic AI, the way that we ultimately interfaced with it was via a chatbot.
Yeah,
we're asking questions in the way that we would have asked Google. And you probably know this, but before AI, the average number of words that in a Google search was around 5. And after AI, the number of words in a Google search expanded to about 12. Now, I don't know what the latest numbers are, but the token windows for these AI tools can be 1 million tokens, which essentially means you could drop, the whole of War and Peace into an AI as a prompt and ask questions of the entirety of the book. But of course, people didn't know that that's what you could do. And of course, in the early days, and of course, who would? So for an enterprise, if you're trying to, so we should have said already, what is it that AI does brilliantly? It synthesizes information in a way that humans cannot. Our excitement around what that means is just things like, think about breakthroughs, think about von Neumann or Edison, or look at human history. The polymaths are a very large part of the breakthroughs that humans have enjoyed. But of course, humans we're not polymaths. We're actually, here we are today. We're experts in a very sort of thin slither of knowledge, and AI is able to bridge that in a way that, I don't know, let's say NASA did to make sure that the US landed on the moon first. And I think we're super excited about this idea that essentially AI can synthesize information. You can take, I don't know, let's say 60 minutes of what would have been human time could be done in, I don't know, 1/100th of that or something, or maybe 1/10 of the time. And so that ability to synthesize information means you can start going across modalities and all sorts of stuff. And that's where our excitement comes from. So go back to the point. Why is it non-human scaling? Because in the end, we were interfacing, we would ask a question, we would get an answer back. But of course, if you could task AI with a problem, that problem might be, can you find me 3 interesting ideas in the Korean market that are tradable and might be an interesting way to get access to X, and it can actually deliver that. That has demonstrable value to me as an investment manager. So one of the things that we've been doing, many of the things we've been doing, but 2 years ago we added somebody to our team dedicated to drive AI through our investment process, to what we called supercharge it. And that process begins with trying to get all your data in a sort of state of readiness.
That's the first bit, isn't it?
Right. But then it's all about trying to sort of juggle and, which are the best tools out there, and ultimately sort of feeling your way, because the industry is still very nascent. We're now at a point where we can ask, and not ask, we've now built essentially agents that are able to crawl for things that we find interesting. So let's, I don't know, cross correlation, something that might have been the preserve of someone in the stat arb business, or a hedge fund that's trading on Again, we're not traders, we're investors, but
Mm.
wouldn't it be interesting if we could access that part of the market? And now we have agents crawling, looking for interesting correlations that might be something that or interesting companies that fit the profile of businesses that we like. That's AI substituting for human labor. So to get back to your question from a while ago, who's paying for this? This idea that people are beginning to, we've seen some high profile comments, I think, from a few very important companies like Walmart and others saying that they're having to sort of maybe retrench a bit in terms of some of their spending. I think it's worth just recalling that, we don't know the numbers exactly, but let's say we're at $100 billion of AI revenues. Let's say we're tending towards $1 trillion of AI capex. It's worth recalling that the global labor bill is 44 trillion and the global OPEX bill is 60 trillion. And it is just worth pointing out, and again, I'm an investor with a sort of a human hat, and as a father of 2 kids that are going to be looking for work within a few years, all being well, this is, I'm not saying this lightly, but it's unusual to see companies like Block, PayPal, I think GitHub recently, GitLab, recently, very large scale redundancies. And they're all calling out AI as the reason behind those redundancies. So I think you're going to have lots of two-way on this, where some companies are telling you that they've spent more than they expected, they've used more tokens than they anticipated. I think one company recently said they'd spent their year's budget in the first 5 months of the year.
Uber, wasn't it?
I think it was Uber. Uber is very much the sort of tip of the spear. These guys are some of the best users of technology globally. So I think that what we would expect is for every one of those, I think that the data points of very large scale redundancies from tech companies that are seeing productivity gains speaks to a sort of medium term trajectory. Where there may be some cross currents around usage, but I think we're really just starting in terms of enterprise adoption.
But I guess when I started my career, like the stuff I started out doing, and let's just for the sake of argument, saying we had a client meeting the next day, or my boss did at the time, and he was going to see a client, but we'd manually work out the performance figures based on the values now and the money inflow now. And we did it pen and paper-ish, whereas now we have software that do that. And likewise, we used to have secretaries, and we don't really have secretaries anymore because we don't really need to type letters anymore. Because and so I guess you've always had this incremental improvements in productivity, and we are talking predominantly white collar now. Sure. But are we saying that the productivity improvement that comes from here is more than incremental, and it is potentially, for the big tech companies are laying off a load of people, presumably that it is quite meaningful?
I think that we didn't see anybody lay people off because they had smartphones, and we didn't see people have mass redundancies because they just got access to the internet. I think, again, has SaaS software reduced the number of people in an HR department? It absolutely has. Yeah. But that's, we've been at a departmental level. Have there been meaningful productivity gains to software? Absolutely, there have. And one of the anyway, let's not go in. I could get sidetracked into talking about US productivity and comparing it to various other countries, including our own. This doesn't feel evolutionary. This feels very different to that. This would feel much more like railroads or electricity. Again, and in those early days of electricity, I'm sure people were sort of saying, well, I don't really see the gains. Steam did this. But of course, you can't obviously predict what's about to happen. I think one of the challenges with being, with staying the course on an investment story like AI is that the narrative is always confined to the sort of present, or maybe present plus a bit. And I just was reading the history, and again, I'm giving you my scoop on this because I haven't even published it yet for my annual report. But
you're a history graduate. So
that's what I did at university, certainly. But I've really enjoyed over the years trying to draw on the past to try and illuminate the future. And nothing's exactly the same, but the idea that what's happening to us as a generation that is unique beyond the detail seems highly unlikely. And so we've lent on lots of different industry parallels to help us before. But one I thought was very interesting was that in 1901, Standard Oil was already the second largest company on earth, and made billionaires. Oil already made billionaires of people, but oil at the time was actually just for lighting. It was kerosene, and all of the lighter stuff was just basically burned off. And the reason for that was that coal was basically a quarter of the price. So in 1901, there was a find in Texas, or summer, I think it's called Spindletop, and at that one moment, that they found more oil, I think, in that one place than the entirety of the oil industry in North America. The oil price falls to below the cost of water. then normalizes at the cost of coal. But what's really interesting about it is that it took, I think, within the year for ships and railroads to start basically moving from coal to oil. But of course, that's not the story at all. The story really about oil, and again, this is very simplistic and I haven't read enough on it yet, but I'll just put it out there, is that it was the change of state from solid to liquid that basically created this portability that didn't exist before. And it also, interestingly, and why I think it's interesting is obvious, which is it took a lot of humans out the loop. When you're mining a solid, you're digging it out of a mine, and then you're moving it physically, and you're putting it onto a train, and so on. And every part of the process involves humans. And of course, what you need to do, of course, if you're ever going to design the car or the plane, or if you're going to create a petrochemical industry, is have something very different. And I think that those things are they're not viewable or knowable from the boiler room. And I think that's, again, it's another parallel. I think that also the parallel works because that reservoir in that place in Texas is a little bit like, I think, the sort of the well of cognition that we're opening. There's so many things that humans haven't been able to even scratch the surface of, feel like they should be coming into I don't know, it should be coming into our vision or whatever it is over the coming years, because will be unlocked or unlocked in the same way that oil was in 1901.
Can we take a step back to when you started your career?
Sure.
Because John and I weren't managing portfolios in 2000, and we've obviously read lots about it since, and probably more so recently with people calling out, AI as being a similarity, and we've seen it before, and businesses have got too valuable. Obviously, the revenue situation and profitability is very different. But sort of, what would you say to our client base who do ask these questions of, it does feel quite similar, and there's lots of articles saying it's the same, etc. So what would be sort of the pushback and explanation from your point of view?
Look, I mean, there are similarities because we're obviously building infrastructure from scratch. And again, if you went back to that early period, it was really driven by the idea that there was a new way to carry network traffic or telecom traffic, which was once circuit switched and then became packet switched. And I remember as a youngster, my grandparents were sort of snowbirds in Florida, and the parents would wake up in the middle of the night in order to find the cheapest way to phone them because it was super expensive to make international phone calls. And then the internet happened, and then the smartphone happened just to kill off anything that the telecoms thought they were going to be able to capture in terms of that. So, I mean, there are definite similarities between that period because we're building infrastructure from scratch, and today the infrastructure are data centers, and the pipes that we need today are maybe fiber optic cables, but actually same stock, same companies that survived from that period. So definite similarities. The scale, the pace of the build, some of the hyperbole, the number of tokens are doubling every 100 days is not quite right, but it's not that far off. I think it's less than that. But they are the sort of things that we heard during the late 90s. So, history doesn't rhyme, it doesn't repeat, it rhymes. That's all true. I think also, honestly, I think those periods, for me too, there's a lot of scarring. And I think people that were late to the dot-com period will be sort of, I suppose, will remember the bad bits. They won't necessarily remember the early years. I don't, again, we were on bubble watch the whole time.
Yeah.
And, we think 2/3 of CapEx today is now going into supporting inference.
Right.
Inference is the stuff where there should be revenues against.
Yes.
So
by definition.
Yes. Well, sort of. I mean, obviously you can have free users. You can give away tokens. You can have business models that make no sense. And just to be clear, we haven't looked through the financials of either OpenAI or Anthropics yet. But
we will be able to soon, though.
That's right. So that doesn't mean that there isn't a problem. But ultimately, this isn't about chasing a model down that one day is going to find a cure for cancer. This is, we think, 2/3 of that money is now. And I mean, just today there was a comment from somebody senior at Anthropic saying that they're still short of capacity. So what's so fascinating about this period has been, again, it does feel slightly frenzied at the margin because all of a sudden there's not enough compute. 5 minutes ago, there were some very sensible people in the world saying that there was a bubble at 250 billion of CapEx. And now the leading AI company in the world, I think it's fair to say, or certainly from a model perspective, is telling you there's not enough capacity. So, of course, in the end, all infrastructure builds end badly. It must be true because we'll end up extrapolating at a certain point, or there'll be some tech breakthrough or the guy that thought it was a really good idea to plow a whole bunch of money into the next canal or the last canal, it then gets presented with the railroad. So, of course, there's risk involved in these builds. But just quickly, they're the similarities. The differences are, and again, there are many differences, but ultimately, there are revenues. Yes, that's true. There's a the time to adoption seems violently different. I mean, if you think about just how many people are using AI, how quickly people have got to tens of billions of revenues. In contrast, we haven't really seen that much M&A. M&A was a feature in the late 90s. Cisco was buying everything that moved. Again, I'm a holder of Cisco, so I hope they don't take offense to that statement, but they were, and they weren't alone. We had the IPO thing we referenced earlier, 5.5 years from incorporation to IPO. We had, it wasn't just the nature of the IPOs, it was the volume of the IPOs. We've had a handful of IPOs so far. The IPOs have been companies that we've largely actually sidestepped. Companies that are in the sort of neo-cloud part of the market, which, again, they've been good investments, but we've preferred other things. So I still see more differences than I see similarities, but we are 3.5 years on. And I would say that the participation in the AI trade is obviously greater than it was 3.5 years ago. So I think it's right to be sort of certainly more alert to bubble tendencies if you see them.
And then, a cynic would say that the insiders are beginning to sell. So we've not had any IPOs yet, but tomorrow we get a big one, which is AI adjacent. But Anthropic and OpenAI have filed confidentially so far, and then we'll get that. I don't know what the timeline is, but it's going to be months rather than years.
Yeah, correct.
So insider selling, is that sort of paranoia about bubble watch? And I think James and I and the rest of the team at QC would be very much in the same camp. I mean, is that the sort of an amber flag, a warning sign, or is that a sort of natural progression and the way of the world?
Well, look, I think in the end, or to start with, I should say, I mean, being in the AI business is an expensive game. This isn't something that's available to most companies. Again, if you meet almost any software company, perhaps with the exception of Microsoft, they have to tell you a story around, let's say, model commoditization. And it may or may not be true. They may or may not believe it. I mean, they may not have even said that, but I mean, that's my impression, because these companies don't have the ability to be in the frontier model market. It costs hundreds of billions of dollars for a training run, and it's cost billions to get to this point. You can see how hard Meta is finding it to be able to compete at the very frontier with Anthropic, OpenAI, and Microsoft. You could see what I think the rumors were that that Elon had spent, certainly spent $15 billion of cash flow, I think, last year on XAI. Again, so this is an expensive business, and it is going to continue to be expensive because, I said earlier, it's sort of an order of magnitude more for a 100% model improvement. The reason that you'd spend that is because if you think you're going to be able to monopolize or oligopolize, if that's a word, a $40 trillion market, you really do have to have the best model. Ultimately, we try to employ the best people. We would naturally want to substitute them with the best model. Yeah. So I think the coming to market in itself is a function of a few things. One of them is it's a capital intensive industry. It's one of the other reasons, another reason why we've de-emphasized some of the Mag 7 in the portfolio, because these have been mostly capital light businesses that are becoming increasingly capital heavy or heavier.
Very physical.
Right. And you're going to have years of depreciation flowing through that you don't really fully see yet, and all of that stuff. The other argument might be that if you don't have a large language model that's at the frontier, you could still be useful and have a very relevant place in the world if you owned the plumbing. Anthropic doesn't have enough compute. OpenAI is not a hyperscaler. And so it's been obviously signing contracts galore. It was very early to the potential risk of a shortfall of compute. And I think that Anthropic has been more measured in terms of how it's been spending, and now it finds itself with it's like having a hit record and no one to distribute
problem
it.
To have,
it's an incredible business, yes, but because ultimately, they've described this to a colleague of mine as being, if you ultimately make a very big all-in decision on infrastructure spend and your model falls short, or you can't deliver the model, or the takeoff happens later than you can go bankrupt. So I think that this is a capital. There are lots of capital requirements in the fact that Google will come to the market. You could say that they were trying to. There are lots of reasons why Google may have, or Alphabet had come to the market to tap liquidity. I think Microsoft just have sort of alluded in the last few days, or maybe even yesterday, that they wouldn't rule out the potential to come. Meta was rumored it might
I
be coming.
saw that.
This is if you're going to be in this game, and it's not a game. This is we describe this as discontinuous technology progress. This is one of those rare moments where a lot happens in a very compressed period of time. And the risk is, if you're an Amazon or a Google, is that if you don't have sort of the infrastructure to carry other people's models, or if you don't have a model of your own, or indeed a chip of your own, the risk of commoditization is there. These are the smartest companies on earth. I think that is one of the biggest reasons why we don't feel that this is a .com thing at all. The telcos of the 90s, I mean, they were impressive businesses, but I wouldn't say that they were necessarily the smartest people on earth. But I would say that about almost all of the Mag 7 and the Frontier.
And they've shown themselves to be very agile over the years. 2022, off the back of the COVID boom, Microsoft got rid of 15,000 people. Meta got rid of a lot of people. Shut down what was the stupid business with immersive? What was it called?
Well,
the metaverse, the whole metaverse thing.
They've certainly done. They've pared back Reality Labs. But I mean, look, AWS is. I mean, Amazon created the cloud, or certainly they were the first company to the cloud in 2005. These are brilliant businesses. So I think we'll see what happens. But I think that the idea that companies are coming to market means that that it's an amber flag. I'm not sure about that, but I think that when there will be other things that we'll be more concerned about. And I think some of the valuations of the sort of very the companies at the coalface, they have expanded. When we look at the overall aggregate valuations of tech, they are sort of normal.
Yes.
But that sort of belies the fact that there are
software has come down.
Right. And there are some cheap stocks in tech today, which we haven't talked about disruption yet, but they are the ones perceived to be on the wrong side of the trade. When you back those out of aggregates, then you're paying obviously a higher price for the right companies. Again, I still think you're miles from where we were in the late 90s when we were basically putting peak multiple on peak earnings. But just to be clear, and we haven't talked about this, but we like to remind everybody, your listeners as well, that between 94 and 98, where we were in that sort of healthier part of the internet build out, there were 7 setbacks of 15% plus against the backdrop of very strong returns, but there were 7 very tough periods. And at the time of doing this podcast, some of our stocks are under pressure for reasons known to themselves.
And the story of 2026 so far in the AI game has been that of memory and CPUs, as opposed to Nvidia. The poster child hitherto has having a little rest. Stock's pretty much unmoved in 6 months, and we've seen the likes of Micron, Seagate, obviously Hynix, Samsung as well have gone ballistic. To come back to the point about valuation, those stocks were on 5, 6, 7 times earnings because they are hugely cyclical. And Micron's EPS is up I've seen the chart, it's like up 10x or something.
Yeah, it trades. I think it trades on forward to 6 or 7 times forward today, despite the fact that what the stock has done, because as you say, the numbers have basically driven the return.
Is that sustainable?
I think it's an interesting one, because Jensen Wang of Nvidia, I think, is also head scratchy about why the stock hasn't performed well. The company's delivered and upsided, and revisions have been positive.
And the valuations just come down to 17, 18
times? 17, 18 times, yeah. So again, sub-market multiple for a business that should grow faster than the S&P doesn't feel right. But you could argue the same for TSMC in Taiwan, which has been a very good performer, owned by everybody, I'm sure, in my world, but hasn't actually kept up with some of the sort of coalface names. So you could say that they were funding shorts, or that they are a source of funds for people to invest in racier alternatives. I don't know. That feels like a partial explanation to me. We've been investing in Nvidia for a very long time, and it's the number 1 position in the portfolio today. It is a meaningful underweight against the benchmark, just for the record. Likewise, Broadcom, which has the maker or the co-maker of Google's TPU chip, and lots of other important silicon in the networking world. We're again a reasonable sized position, but a meaningful underweight. And I think in both cases, what's difficult for the stocks is that they are both, the narrative of them as market share losers is quite difficult to shake. And I think, to your point earlier, what's happened with the agentic story this year is that you can see this in Intel, which is probably the very best example of a company that honestly 2 years ago I would have said I couldn't imagine owning again, and is now a top 15 stock in PCT for lots of reasons that we don't have to go into. But in the end, it's the CPU renaissance that has awoken this slumbering giant.
Mm.
But just to recap why that is, when you task your LLM with when you ask Claude to go out and find you 3 interesting stocks, the work that large language model is doing is there's an awful lot of tool calling and the sort of stuff that a human would do in order to identify. You would be trawling lots of indices, you'll be reading lots of stuff, but then you'll be bringing it back into token space. You'll be doing the task that a human may have taken hours or days to do. The LLM is doing in a few minutes.
Yeah.
But those tasks are serial tasks. They're the tasks that we would have done with our PC. And so all of a sudden, the CPU has become a bottleneck that didn't exist in a pre-agentic AI world. And I think that, honestly, that's just a function of the fact that AI is moving at such a rapid rate that it's almost impossible to predict where the next bottleneck is likely to turn up. So one of the things that we are, doing and trying to stay on top of, and we're a team of 12. We do 1,000 company meetings a year. 6 of my team were away at conferences or trade shows last week, trying to understand where the bottlenecks are, and perhaps where they're likely to become less interesting over the next 6 months. Because in the end, we're capitalists. We believe that capital will turn up to ultimately try to arbitrage these profit pools that have been created by bottlenecks. To your question directly on memory, we were very overweight memory, but we still own it, just to be clear. And we've taken that down. But we still own SK Hynix, we own Samsung, we own Micron, we own SanDisk, and we own semiconductor capital equipment companies that will be providing them in time with more gear to produce more chips. It's going to be hard. So the term bottleneck is a funny one because it sort of implies something that's very likely to be resolved quickly. But it takes years to build memory fabs, and it costs tens of billions of dollars. So some bottlenecks will be resolvable easier than others. If you take hard drives, you said Seagate. We own Seagate and Western Digital. We own Hoya, that makes substrates for those hard drives. And this is an industry that, if you went back into the 70s, there were, probably 50 or 60 players in hard drives. And then we've shaken out to basically 2.5.
Commoditized to nothing. Yeah.
Right. And I think that sort of, we've discussed this already, that in that process of hardware being commoditized in a cloud world, where ultimately who cares what the server is, because it's a workhorse that lives at Google or wherever, Microsoft. There are very few players left. So these bottlenecks will ultimately be resolved, I'm sure. But I think that the way I think about them is more about price discovery.
Yeah.
What you thought was the clearing price for NAND flash in a smartphone world may not be the clearing price in an agentic AI world, where the agent you asked a task last week is expected to remember that question and be able to build on the work it did the week earlier. That's going to require storage in a way that is a completely different, higher value storage than anything you've storing a photograph on a smartphone.
And is that, in your view, there's a lot more to be delivered from those memory names?
Well, look, we own them, which means that we must like them. And ultimately, I think, again, I don't want to give advice on individual names, because I think that the reason that PCT exists is so that investors don't have to try and rifle shoot in a sector as difficult as ours. And it's difficult because we don't have longevity in a way that maybe you do in, banking or chemicals,
consumer staples.
Consumer staples.
Oil.
Oil, there you go.
Oil.
I knew, I told you earlier I'd chosen well, perhaps I should have chosen badly. We don't have that longevity. And we also have, everyone knows that return profile, a few companies deliver all the returns, not just within tech, but also in the broader market. So we exist so that people don't have to rifle shoot. What I would say about our excitement around memory is, like I say, I think the fact that people consider it a bottleneck and ultimately will be resolved is almost certainly true. The question is, time. Are we playing for a higher spot price in DRAM? We are not. But if you believe that the duration of this period extends, then we would say Micron is too cheap. And I think that would be applied or applicable to all of those commodity companies. And I think so that would be true of the hard drive companies. There are companies in Asia. We have just shy of a quarter of our portfolio is exposed to Asia, and a lot of that is in names that we've referenced already. The very largest companies, but there are a whole bunch of smaller companies that tackle much less important, in inverted commas, areas than memory, but that are bottlenecked because of this need for kind of performant hardware that we haven't needed for 20 years.
And then probably last one for me. I got two really. The IPO, SpaceX. Any thoughts on that? It's 100 billion of sales for 2 trillion of market cap. I mean, make it make sense.
I'm not going to comment on the valuation or what we're going to do. And by the time that your listeners hear this, they'll know how it turned out. Look, I think the area, the space of space is a very exciting one. I mean, it has been for a long time. We obviously don't do privates. We didn't talk about that, but I mean, it's worth just reminding everyone that if you're going to pursue bottlenecks, if you have a fear of missing big winners, you absolutely have to be, pay a big premium for liquidity in your portfolio. We have a reasonably high turnover in the trust. We have had for 20 years. And it really is this idea that if you're not Microsoft, then I might want to sell you and put you back into the top of the funnel to find the next Microsoft. Ultimately, looking for the big winners, and know I can't afford to miss them. So there's a healthy turnover of names in the portfolio, and that's been really useful in a market that's been moving as fast as AI. So coming back to this idea of not wanting to miss big winners, we've been excited about the space area, but not able to access SpaceX because we don't do privates. We have held a number of smaller positions in companies that are operating in the same world, but are a long way from where SpaceX is. For example, I think 9-year head start in reusable rockets is quite meaningful, and obviously no one has an Elon. And just recently, even XAI, which some people were quite negative about, Grok has been sort of a reasonably distant number 4 or 5 in the frontier race. The fact that Anthropic and Google are now wanting to access XAI's Colossus data centers speaks to, again, he's a very, very special CEO, and this is an incredibly exciting space. So again, what I will say about all 3 IPOs is that all of them are unique, or non-fungible, leading players in markets that are important. And I think that, like you said, SpaceX is AI adjacent. There are definitely scenarios in sort of hyperbole cases where being an end-to-end provider, and of course he has aspirations around chip manufacturing now, which you probably read about in Terafab. So again, I'm going to be careful how I phrase this, but you would be surprised if we weren't interested in all 3 assets, given their scale, non-fungibility, and the markets that they operate in.
Yeah, of course. Final question before we wrap, because it's probably nearly time that you went to meet your friends for a glass of Diet Coke.
Right.
I mean, we've talked a little bit about disruption and AI disrupting labor pools, and we've also touched on the power element and how power prices have gone up, particularly in the state. Is there a risk of public opinion turning against the whole AI thing? I mean, generic opinion polls, both sides of the Atlantic. Do you like or do you dislike AI? They're not wholly in favor of liking AI.
It's a very
simple question. Is that a risk to the whole rollout?
It's a very good question, because I think it's in contrast somewhat with social media, actually, back in the day. I mean, maybe not today, where there seems to be much less positivity around social media, and again, let's not go there. But I think people are more ambivalent towards AI. I think that, as I say, in contrast to all the disintermediation benefits that the internet brought, so is there a risk that there could be a backlash? I think that at the margin, you're seeing that a bit already in things like, I don't want this power station or data center in my backyard. I don't know if that's a NIMBYism or what have you, but there's definitely some pushback. I mean, we've been shielded, I think, from that meaningfully to date by President Trump, who has surprised us and I think everybody else by being incredibly pro-AI.
It's amazing what happens when they all contribute to his campaign, isn't it? Sorry.
Wow. I would say, actually, not that I have any reason to know or not know that, but I would say it's that we've been relatively sanguine about that risk to date because of the bigger race, which is sort of supranational race.
Yes, it's the geopolitics.
Right. And I mean, if you liken this to an arms race, which we did and have and still do, then there's obviously a race being run by the frontier labs within the US and within China in their respective markets. But ultimately, the race is between the US and China. Yeah. And that has turned up in, potential export bans and rare earth skirmishes, which speaks to this larger battle. So my gut feel on this is that there could be. I don't think that in terms of public reaction, and could it be a sort of a slowing function? I think that, again, a Democrat administration may feel different. So that's something to monitor. But I think that all countries understand that this is going to be a critical resource or critical output, depending on how you view it. And therefore, I think they're going to try their best to ameliorate those type of concerns. However, if we're talking about risks, we should, because we're IO maximalists. We're very excited. Again, we know that volatility is endemic to new cycles, but I think it is worth pointing out that if this is an arms race, then there must surely be a Manhattan Project risk too. And Anthropic has been sort of vocally calling for not necessarily a timeout, but something similar where we need to agree to AI constitutions. We need to think about providing guardrails that we haven't necessarily, and of course, we're not deaf to that. We're not blind to those type of comments. And so I think that one of the upside risks associated with AI, and you saw this recently, at least at face value, with the Mythos model from Anthropic that's been held back until today, actually, with being released as Fable, is that what if AI starts to become a bit too powerful to be trusted in the private world? Wouldn't trust nuclear or atomic weapons with enterprises. That's got to be state monopolized. So there is that. And one last thing, maybe on the labour, because I think at the moment, I think you probably are beginning to see some of the impacts of AI in the labour market in the form of youth unemployment.
Gradual unemployment.
You see it in the UK. You see it in India. Actually, there's quite a challenge happening there, but some interesting stuff happening politically because of very unusual levels of. And of course, you could argue that the Indian IT industry is on the wrong side of the AI trade as well.
Yeah, totally.
So that's unhelpful. So I think perhaps the risk that we're most focused on is what if, and we've seen this with with levelers and wreckers and a whole bunch of other people over the years through history. What if there is a period of time where the impacts, whether utility to AI trails the job cuts, the disruption. Disruption always turns up before the benefits for these important technologies. And could that, in democratic systems, result in laws or regulations designed to slow it? I think that has to be considered as a real risk.
Well, we've been living in a very populist world for the last 10, 15 years, and you could say that the atmosphere is quite febrile. So wouldn't rule it out by any stretch.
No, but I think it's one of those ones where you would expect someone will want someone else to blink first, because the idea that you would be considered, or you would be castigated for being the person that stymied AI, in the same way that you would have been at the time of electricity. Exactly.
Yeah. Any more questions, Hughes, before we wrap?
No, I don't. I mean, yes, lots more, but we've run out of time. I guess my sort of comment would be, if you looked at the portfolio maybe 5 years ago, it was sort of dominated by large cap stocks, which also dominated sort of the big indices that we own. It looks quite different today, and it's doing something quite different to what the large indices are doing. So presumably that's more exciting for you because you can get there's real opportunity for outperformance versus.
I think so. I mean, look, we hope
what
so.
Markets are
it's
doing,
been I think you're quite right, which is that Mag 7 is deserves the moniker, and before it, Fan Mag and whatever they were called. These are the dominant winners of the cloud smartphone world, and they've actually, despite all the narrative against them, they've earned their place in indices. Their earnings contribution to the S&P, to tech earnings, to tech sector earnings has really been commensurate with what they've delivered.
Yeah.
That feels less likely to continue as they become asset heavier. Or capital heavier, but also as some of those profit pools fall into potential scope of AI disruption. So that's not unhelpful. I do think also at the same time, the AI, I suppose the shadow cast by AI and the disruptive impacts that it's already having at the sort of amongst the weaker players within the software world or information services world must extend. In a world of agentic, and I'm talking here more consumer agentic, you would imagine a lot of the digital platforms that were created to help humans who value time greatly, who are attention scarce, and have been able to monetize very large parts of the profit pools associated with real assets like hotels, would fall potentially into the shadows of AI disruption. So, I mean, yes, we're about 50% today active relative to our benchmark, but it's an actively active portfolio.
Yeah.
So I would imagine that 5 years hence, that the names that you've been surprised by might not even be in the portfolio, perhaps in a shorter time frame than that.
Okay, really helpful.
Ben, what a treat it's been. It's been a whirlwind tour. Thank you very much.
Thanks for having me.
PCT, 30 years old, 65 bagger. Keep up the good work. And
We'll try.
I'll see you next time. Thank you. Thank you, Husey. Thank you, everyone, for watching and listening again today. Any questions, let me know. My email address is jonathan.raymond@quadachieveit.com, and we'll see you next time. Thanks very much.